This video is an excerpt from an interview I did with Tom Reed, who's the VP of China Oil for Argus Media. And in it, we talk about oil demand in China over the next 10, 15 years, maybe out to 2050. It's very confusing, and there's lots of uncertainties. The uncertainty bars are very large here. So what I've done is I've come up with three scenarios to simplify the issue and to create a framework within which you can understand the conversation that I'm about to have with Tom. So let's start out with some basics. Chinese oil demand is about 17 million barrels a day. And what that means is on the road transport sector, so that's everything from cars and trucks to two-wheelers and buses and medium delivery vans, all of that is 12 million barrels a day. And the refining and petrochemical sector is about 5 million barrels a day. Now, those numbers aren't firm because Chinese data is not very good. It could be as high as 17.4, as low as 16, and some of the sectors are a little soft, but that's okay. Tom says that these numbers are reasonable, so we'll go ahead with them. Now, here's scenario number one. And this is very good for Alberta prospects out to middle of 2030s and beyond. Road transport demand remains steady to at least the early 2030s, and petrochemical demand grows by 1.5 million barrels a day. Overall demand rises from 17 million barrels a day to 18.5 million. Now, there is no chance that the road transport demand is going to grow. China is, as Tom will tell you in the interview, is electrifying its transportation sector as a geopolitical as well as an economic strategy. And this year, estimates are that 55 to 60% of new vehicles sold will have a plug. And that's going to increase. The IEA thinks that by 2030, it'll be 90%. So there's no chance that it's going to go down, but let's assume that it remains steady and petrochemical demand and refining demand rises. And then you have 1.5 million barrels a day of extra. That's an opportunity for Alberta. Scenario number two is still good for Alberta, but it's a much smaller opportunity. So their road transport demand drops by 1.5 million barrels a day, while petrochemical demand rises 1.5 million barrels a day. By the way, the petrochemical demand comes from both OPEC and IEA modeling. So that's, from now until the 2030s, that's a reasonable estimate. In this case, overall oil demand remains steady at 17 million barrels a day. And, it's basically the status quo. And there are opportunities for Western Canadian Select or for the Alberta heavy crude in the petrochemical complexes that China has built and is building. Scenario number three significantly reduces Alberta opportunity. So in this case, road transport demand drops by more than 1.5 million barrels a day. Petrochemical demand grows by 1.5 million barrels a day, and overall demand begins to decline, and that trend lasts until 2050. Now, I did a video last week in which I compared various modeling scenarios, including 3 from China. And the Chinese modeling shows that the overall China demand is going to fall from 17 million barrels a day down to 7.5 million to 5 million barrels a day. So the Chinese, and this includes 2 state companies that are involved in the sector, are expecting that oil demand is going to fall. So based on that, I think scenario number 3 is a reasonable concern. It's a considerable risk factor. So here's the interview with Tom, and I'll be taking some other clips from this interview, so watch out for them. What's your take on the argument that China is growing out its power sector, installing enormous amounts of wind and solar, building advanced nuclear, building new hydro dams, and still burning a lot of coal because it wants to electrify its transportation sector, not just cars, but buses and transit, so on. And in order to displace the enormous amount of oil that it imports every month. And so the betting is, in the modeling I've seen, is that Chinese demand for road transport fuels after 2030 will decline significantly. What would be your take on that?
I think it already is. And we've done some work on this ourselves. And demand for gasoline and demand for diesel in the Chinese market is shrinking quite rapidly. It's being aggressively substituted by electricity in the transport fleet for the reasons that you outlined, that China is a very, very low cost electricity producer, and it makes far more sense to run an electric car in China than it does in a gasoline car. You know, the cost comparison is crazy. It's about 10% of the cost of running a gasoline car, running an electric car in China. So far, what we've seen is that the demand losses there are being offset by demand growth from the petrochemical industry. So Chinese demand in aggregate continues to grow and is actually growing slightly above our own forecasts for this year, which perhaps were a little weighted towards the diminishing demand from the transport sector.
What is the long-term demand forecast or outlook for petroleum demand in China for heavy crude? Because the modeling that I've seen from agencies, like OPEC and International Energy Agency, is that petrochemical demand grows very rapidly in the 2020s, from now until 2030, into the early 2030s, but then moderates. And maybe in China might pick up another million barrels a day, million and a half barrels a day. Is that kind of in line with your thinking?
I think it's a really interesting question, and it's a slightly fiddly one to answer, because what we have in China is essentially a sort of there are two refining sectors. There's the state-owned and sort of highly advanced, independent private sector companies, including a lot of Canadian crude buyers like Rongsheng. And then you've got the smaller teapot market in a province called Shandong, and that is the slightly unknowable variable in the Chinese market. So if you look at the kind of crude that the teapot refineries buy, until 2022, it was light sweet, it was medium sweet crude from the Atlantic basin, it was Brazilian, it was West African. Then they shifted to Iranian barrels. The government in China does not approve of these teapot refineries. It would like to shut them down. The local governments in Shandong are obviously defending them fiercely because they're vital generators of tax revenue. So the outlook for demand from Shandong is kind of hanging in the balance, and that has knock-on implications for the amount of crude demanded by the state-owned companies and by companies like Rongsheng, which buy Canadian crude. Because if the teapot refineries increase their supply of product into the Chinese market, then it will squeeze out demand from the state-owned companies, which are running the Canadian crude. And currently, it's very hard to gauge exactly which of those impulses is going to emerge triumphant and which of those tendencies is going to endure. What we've seen so far this year, however, is a massive growth in demand from the state-owned companies and a shrinking of demand from the independent sector. And that, I would say, is quite bullish for Canadian crude demand.
Tom, we've talked about some uncertainties, and this one, the demand, the uncertainty around the teapots. We've also talked about the other competitors like Saudi Arabia and Iraq discounting their crude to compete with Alberta crude. What other uncertainties might Canadian producers consider, going forward?
I suppose the big one that Canadian producers are looking at currently is the outlook for the refining sector in the US West Coast, where we've got a couple of refineries shutting, and potentially that will reduce demand from the US for Canadian crude. Currently, my assumption would be, however, that China will mop up any surpluses that emerge as a result of refinery closures in the US, and that those barrels would just shift to China and potentially other Asia. Particularly, I think if you lose demand for Cold Lake, which is a less acidic version, essentially, of AWB, from the US, then that kind of opens up a new source of supply for other refineries in Asia, which maybe outside China, they can't take the Access Western blend, but they would be happier with a lower TAN variant, which might be Cold Lake.
And I assume that you're talking about refineries in Korea, Singapore, Japan.
Yes, and potentially India as well. India has been looking at some of these cargoes. I'm not aware that it has bought any Access Western blend. It may have taken some Cold Lake, but yeah, the Cold Lake is more digestible because it's far less acidic. I think a lot of the time, even in China, they would need to blend down the Access Western blend to get its acid number to a sort of more digestible level.
We should address that for a moment. My understanding is that most refineries can process a crude with an acid ratio of about 2%. And the AWB, WCS tends to be up around 3.5, which requires, special metallurgy in the refinery or blending with a lighter crude. Is that more or less correct?
Yes, and it's slightly complex, and I'm not a refining engineer, I'm not a chemical engineer, but I think the key thing is that you need a crude that has a comparable residue density to the TMX that you're trying to blend down. And actually, one of the things that we've noticed in China is that China does have access to the perfect blend stock in the form of Russian ESPO blend, which of course is almost exclusively going to China. The ESPO blend pipeline comes out of the far east of Russia, just 5 sailing days away from China. It's very quick and easy to move those Russian barrels into these Chinese refineries and to blend them with AWB to get the acid number down.